Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Bernoulli. Today we have Charles Hugh Smith. He's author, leading global finance blogger, and America's philosopher, we call him. He's the author of several books on our economy and society, including A Radically Beneficial World, Automation, Technology, and Creating Jobs for All, Resistance, Revolution, Liberation, A Model for Positive Change, The Nearly Free University in the Emerging Economy, and also recently a book called Pathfinding Our Destiny, Preventing the Final Fall of Our Democratic Republic. His blog of twominds.com is one of CNBC's top alternative finance sites. Welcome, Charles.
Thank you, Richard. It's my pleasure.
Great. I thought today we'd like to do a focus on discussing something which is brewing, which has the potential to morph into another big global financial crisis, perhaps bigger than what the world experienced with the 2008 financial crisis. And it's the Repo crisis. Repo standing for Repurchase Agreement. It's a new crisis that essentially has just started in September, towards the end of last year. Your initial thoughts?
Well, Richard, I am hoping that you can help explain the ins and outs of the repo crisis to me, because of course I read the financial media, but I don't feel like I have a complete grasp on the dots that connect the repo crisis that started in September of 2019 and the potential you're describing to morph into a global financial crisis. So maybe you can kind of walk us through how we got to that point. In other words, what happened in fall of 2019 that triggered a repo crisis and triggered a massive Federal Reserve intervention, in the tens of billions a day or week. I mean, and I think my kind of general context is what's staggering to me is the scale of intervention. It is like far beyond what would by historical means be usual or common or typical. And instead, these the volumes of repos the Fed was acting on are in the hundreds of billions, and the scaled they basically did very little between 2008 and 9 and the present. So for 10 years they were sort of quiet on the repo front, and then suddenly they're doing hundreds of billions of repos. That's pretty striking.
Yeah, it's just staggering. And you've graciously been able to provide some charts to some insight on that as well in terms of the Fed's balance sheet. We'll get into that a bit later. But yeah, it's a very complex subject, and we'll try to link the dots and the dependencies as best we can. First, I guess, is a definition, a repo. What is repo? It stands for Repurchase Agreement. It's essentially a sale and repurchase agreement that is formed as part of the short-term lending in the market of about approximately 2.2 trillion is the size of the repo market. And what happens is it's mainly in government securities. A dealer will sell underlying security, some type of government security, like a bond, and to investors. So the dealer sells the underlying security to investors and then buys them back later. And that could be shortly in terms of a day or a couple of days or maybe a week or so. So it's quite a short period of time, and usually at a slightly higher price. So the reason this happens is there's an interest to generate cash, to get cash from this, and this is a very important source of cash for banks and the economy in general in terms of this market. So it's a very critical part of the economy. And the crisis has just begun brewing back in September of late last year, September 2019, when the interest rate surged to 10% on the overnight money market, which is quite strange. It went up to a very high level, 10%. And so what happened is this short-term lending market where banks borrow cash from each other to meet reserve requirements at the end of a business day. That's essentially what banks are trying to do, but they were not willing to lend out capital at that time. They were unwilling. They were hesitant to do it with each other. And this begs the question of where is this happening? Where is the cause of this? Why is it happening? What are the factors? So that's a big question, and we can begin to explore that with a quote from Martin Armstrong, who's got some great insight on the repo crisis. And what he points to is Europe. So a couple of quotes here. The crisis in liquidity is that American banks will not lend to Europe. And another quote, the Fed has had to step in to be the neutral lender, not because of a crisis in the USA, but because of the collapse in confidence in the Europe's banking system as a whole. So he's pointing the fingers to Europe. And as you know, there's a significant level of the bond market in Europe that is under negative interest rates. This is having a deleterious effect on the entire banking system in Europe, as well as totally decimating the bond market there in Europe. So it's quite likely the next financial crisis could stem from Europe because of this. So that's one factor, is the European bond market, the European banking system. But there's also other factors as well. So as I mentioned, at the end of a day, at the end of the year, banks are looking to get some cash in order to meet supervisory and regulatory requirements that have been set by regulators. So that's a lot of the purpose of this repo market is to generate that cash, to get that cash. But if there's an unwillingness to lend to each other, they're not able to get it through the repo market. So there's been taking of cash where they've had it at the Fed window, where they've had it in deposit at the Fed. And so that's resulted in a loss in that direction in terms of a cash crunch. And also the Fed itself has been shedding its balance sheet. And you've got a great chart showing that over a period of time, how the balance sheet of the Fed has been dropping up to the September 2019 timeframe. And this is very interesting because what that essentially represents is less cash in the banks and the money market. So it's a cash crunch, again, at a time when the banks need the cash. So that's also another factor. I mean, overall as well, we can say the entire system has a lot of debt in it. There's much more debt now than there was just before the 2008 financial crisis. So we have a system that is levered incredibly at a staggering level. And all of this has contributed essentially to rise in the short-term interest rates. So that if you look at the yield curve on the short end, on the short side of the yield curve at the short end, interest rates have been tending to rise. And so that's what happened in September. The interest rates actually surged to 10%. So the Fed at that time had to step in. And what they did was step in and try to keep their target interest rate of about 2%. So they responded by financing the repos directly. So they offered 2% on these loans to bring the interest rate down and pump cash into the short-term lending market, this whole repo market. And they've been doing this since September to the tune of approximately $500 billion. Even today, they're still approximately 230 billion of outstanding repos on their balance sheet, and so it's just staggering. So they're doing this in the effort to try to keep short-term interest rates low. So it's all symptomatic of central banks losing control. I mean, if you recall back in the 2008 financial crisis, it was all about keeping interest rates at the long end of the yield curve low. So, buying bonds, 10-year bonds, 30-year bonds to try, to help that happen. But normally they have control at the short end. They're able to set the short end. But what's happening now is they're losing control of the short end. So this potentially has dire consequences for the economy and the financial system. Your thoughts?
Yeah, let's walk through those consequences. And of course, we know that the core of financial repression is keeping interest rates low, so households, corporations, and governments can all borrow more money and be able to service that debt, right? And so, why don't you walk us through a bit of the many markets that would be disrupted were short-term rates to go from, say, 2% to even 5%?
Hmm. Well, I mean, you've got several derivative markets like the interest rate swaps, which are a large part of the derivative market in terms of trillions there that could be disrupted with the rise in interest rates, and this has cascading consequences to all aspects of the economy, all aspects of the financial system. You've also got the real estate housing market. As interest rates go up, housing prices generally go down. The bond market, as interest rates go up, bond prices go lower. It's inverse. It just keeps going. It's endless. You've got debt at the public retail level, at local municipalities, a significant amount of debt that would go higher in terms of servicing, also at the federal level, the state level. So all aspects of government and retail would be affected, especially in the indebted Western world. So North America, Western Europe, Japan would all be significantly and severely and adversely affected, if this were to happen.
Yeah, it's I'd like to interject a couple of points here, kind of tying us back to the 2008, 2009, global financial crisis. And when the Fed responded, there's you can find it online, right? That they responded with about 16 trillion in loan guarantees, backstops, lines of credit. And there are charts on the internet where you can look at the institutions that the Fed, either guaranteed loans to, or offered lines of credit, backstopped, and so a lot of that was in fact European banks. In other words, it wasn't 16 trillion to the U.S. Banking sector. That was a significant percentage of the 16 trillion, but a major chunk of it was the European banks. So in raising the specter of the weakness or systemic fragility of the European banking system, it's actually of a piece of the era. In other words, the central bank of the United States is as some people characterize it, really the central bank for the global economy. That the other central banks in Japan and China and the ECB, they do, of course, create liquidity that flows into the global economy. But in terms of backstopping foreign banks, it's pretty much a Federal Reserve action, right? And so, that helps us understand why the Fed had to act. What you're sort of suggesting is the Fed is once again saving European banks from crisis, through the repo market this time. But so it's interesting to think that actually all the efforts of the ECB and all the stimulus and all of the programs, that the European banking system remains as extremely fragile, or in some people's opinion, more fragile than it was even in 2008. What would you say to that?
Oh yeah, absolutely. And it's just essentially the core issue today is in the European banking system, the financial system, the bond market, as being the potential epicenter for a new financial crisis globally. And the Fed has essentially become the central bank of the world in trying to save the world economy, which is again very symptomatic. I want to emphasize of central banks losing control of even the short-term rates. If the rest of the central banks of the world are unable to do it, and the Fed has to be that de facto central bank of the world, and things are getting out of hand at the Fed, then the world is really truly in trouble. It's also comes out in that chart that you've graciously provided. If you want to discuss that a bit and show the magnitude of what's happening, and also how quickly they've had to scramble just in over a few months to increase their balance sheet in order to help this repo market.
Yeah, let's talk to that chart a bit. And of course, the balance sheet there, it doesn't specify what's on the balance sheet. As we know, most of the Fed's balance sheet, it consists of treasury bonds and about $1 trillion of mortgage-backed securities, I think, although that might be dipping under $1 trillion. But I think what I find striking and actually quite disturbing is the Fed took about 18 months to reduce its balance sheet. Right? This was the long program that Powell started of so-called normalizing the Fed balance sheet, which, just to kind of put it in context, before the financial crisis of 2008, the Fed balance sheet was about $800 billion, less than $1 trillion, right? Then it quickly ramped up through QE 1, 2, and 3 to 4.3 trillion, which was just a phenomenal increase in the Fed's intervention in the economy through bond buying over $1 trillion worth of mortgage-backed securities, all to repress interest rates, right, and to provide cash into the system. And before we started recording, you had described this function of the Fed balance sheet as providing cash to a system. And I think that so it took 18 months and they reduced it by 600 or 700 billion. And then they've had to jack it right back up over 4 trillion, basically 4.2 trillion, throwing in like $500 billion in just a matter of months. And so it's clear that a number of things are clear. Number one, the Fed's attempt to normalize its balance sheet has completely failed. In other words, they cannot withdraw that much money from the financial system and not create systemic instability. And I think one of the things we can kind of contextualize that with is, as global debt has gone from about, I don't know, wasn't it a little under 200 trillion about a decade ago, and now it's 260 trillion. I mean, just a phenomenal increase in debt and leverage globally that it's really trapped the Fed and the central banks, that they can no longer remove any cash because the cash is actually short. You know, it's actually collateral is scarce. Is that all this debt's been created, but collateral hasn't necessarily been increased. And so the mountain of debt and leverage is sitting on a precarious foundation. And so if the Fed, that raises the question of, well, if the Fed can never normalize its balance sheet, what is that telling us about the whole global financial system?
Mm-hmm. Yeah, I mean, it's very over leveraged. Essentially, you explained it quite thoroughly, that we've got this cash crunch. And so if base money is decreasing while the number of securities is going higher, it's an increase in leverage overall in the system. So the system is just totally over leveraged, too much debt, and much more than we had just before the 2008 financial crisis.
Yeah, exactly. And so then I submitted another chart to you from Gordon Long of the monthly chart of Apple, and we all know it's gone parabolic, right? In fact, it's exceeding a parabolic curve, and we all know that equities are in a bubble, right? I mean, you just look at Tesla and Beyond Meat, and I mean, it's just all sorts of things. Semiconductor index have gone parabolic. In fact, even the utilities index just went parabolic. I mean, it's like, so when the quote safe defensive sector is literally carving out a parabolic increase, something is really wrong with the markets. In other words, there's too much cash chasing speculative gains, right? And so these kind of bubbles have a history of not ending well. And so I think what I'd like to speak to, kind of as we wrap up, is the unintended consequences of this repo program, quantitative easing, and financial repression in general. Is that the checkers board? You know, it seemed like a simple game. You know, when the central banks colluded and got this kind of solution underway in 2008 and 9, which was repress interest rates, flood the global economy with liquidity, backstops, loan guarantees, lines of credit, so on. And then the idea being that somehow the private sector financial system would heal itself, right? It would somehow start doing the right thing. In other words, reducing exposure, building collateral, reducing leverage. And of course, none of that happened. What the central banks did was, instead of giving them the all clear to be responsible managers of capital and capital allocation, instead they gave them a free pass of moral hazard. In other words, go ahead, take as much risk, jack the leverage and debt levels to insane levels, because don't worry, we're going to backstop everything you do, and privatize. You can privatize your profits, and we'll socialize the losses. And so now we're reaping the consequences, I think, of which were unintended, right? I mean, I don't think anybody intended to blow a massive equity bubble that can only pop with very likely destructive consequences.
Yeah, exactly. All kinds of unintended consequences that were perhaps initially a good intention, but will likely result in a catapulting of all kinds of effects, essentially sacrificing also of the currency, we're translating to a loss of purchasing power, potential rise in inflation from that as well, and just an overall decrease in economic activity, standard of living. I mean, these are all the potentials for the future.
Yeah, and we can talk sort of generally that in a healthy financial system, why would the Fed need to, basically create $500 billion and inject it into the banking system? It's obviously a sign that the system is not healthy. There's nothing remotely healthy about a central bank needing to print $500 billion in a few weeks to save the system from collapse. And so I think we can talk, as you said, about the central banks losing control of the short-term yield curve, but we can also maybe talk about the loss of credibility, because they always promoted their actions as not just saving the world, to use Ben Bernanke's self-satisfied phrase, but it was like restoring the health of the global financial system and global financial institutions, right? And so it's clear that they failed at that.
Exactly.
If the Fed had succeeded, then they wouldn't need to print 500 billion, and they wouldn't need to inject hundreds of billions of dollars in repos to save the system from collapse. And so, and I wonder, if the general, like, sort of mainstream financial media understands that this is really saying in huge neon letters, we've failed.
Yeah, and it's just contributing, as we've been mentioning this theme recently more and more, the loss of confidence in institutions, in government institutions, government in general. So it's not just about coming from political gridlock, but now coming from central banks and their inability to handle the challenges and increasing crises in the financial system.
Right. And we can talk a little bit about real quickly, like, well, how do banks make money? Well, they make money from creating currency, out of thin air by loaning money, newly created money, to somebody, and then collecting interest and fees from the borrower. And so that's why we see this enormous expansion of debt globally. Is that's how you make money, right? You don't make money by trimming your loan book, because then you're not making any money if you're not generating new fees and collecting more interest from a higher a larger loan book. So that system runs into a problem when the collateral is deficient or defective, right? Like it's actually phantom capital. And that may be part of what we're seeing here too, is the Fed is bailing out a banking system which has overextended itself and is really undercapitalized. Scrape away the bad debt, scrape away the phantom capital, scrape away the impaired collateral, and it may be that the global banking system is in fact insolvent.
Yeah, and this is likely to go into some type of major reform, similar to what happened in the 80s with the Plaza Accord agreement. I'd like to end with a quote from Martin Armstrong, who states that the solution to this is beyond the powers of all central banks combined. The solution is not attainable without political concessions, which politically are just off the table. This is going to require a major reform that is unlikely to take place and will not even be recognized until the crisis erupts on a much larger scale. So he basically sees more of a crash and burn ending to this, going into a full-blown global crisis.
Wow, yeah, that's a great summary. And those of us who follow Martin's work, we might want to just mention real quickly that one of his turn dates just occurred. I think it was January 18th.
Yes.
Was timing systems turn dates, and so
yes.
I'm watching the next few months with extreme interest, because if he nailed the turn date, then we're going to start seeing more evidence of that crisis and loss of confidence.
Well, this is all interesting. We'll see how it turns out. Great insight, Charles. How can our listeners learn more about your work?
Yeah, please visit me at of2minds.com, download a free sample of my last couple of books, and check out all my 4,000 pages of archives.
Great. Thank you very much, Charles.
Okay.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.